What's good, guys? Your boy AJ from AP Trades, and welcome to another video. Quick one here for you, going over a little bit with the strategy, talking about the fair value gap and exactly how I kind of use that gap. And I'm also going to go over a trade that I just took here during FOMC. It was a quick scalp, very quick trade. And the main thing I wanted to show you guys here was with this fair value gap. So you guys know that I use this tool here, that box. That's my tool that I use to draw up the fair value gap. This box right here, the rectangle, right? You can find this tool right over here on the side in Trading View. And yeah, it's down there. Star it, so it's one of your favorite tools, right? So I use this tool all the time. Now, the thing about this tool here, right? This is my fair value gap. So let me just make a demonstration fair value gap here. Let me change the color. I'll change the color of the box. All right, so it's candle one. And there is candle two. And here is candle three. All right, so we have, oh, that's not what I want. I gotta change that setting real quick. All right, make sure this is visible as well. All right, boom, there's the candle. There's another candle. Trying to get these right, All right, cool. I'm not going to draw wicks on this middle candle, right? So we always know, right? So the top of the, if we're going up, we're going bullish. It's the top of the bottom candle and the bottom of the third candle, right? Or top of the 1, 2, 3. Our fair value gap is in between candles 1 and candle 3. Candle 2 is the volume candle. Candle 1 and candle 3 are the candles that separate the gap, right? And you're looking from, when you're going bullish, you're looking from the top of candle 1 to the bottom of candle 3, right? So here's candle 1 here. Here's the top of that wick on candle 1 to the bottom of candle 3, right? That is our fair value gap. And I will take my tool here and I will draw this box up across that area, right? Boom. Right, let me change the color of this just for this demonstration. All right, so as you see here, here's our fair value gap. All right, now let me change some settings here so I can help you guys see this a little better as well. Yeah, that's perfect. All right, so you see this dotted line that we have here in the middle of this fair value gap. This is what I really want to talk about here. All right, so you see these black dotted lines across the middle of my fair value gap here, right? Now, this area, right, the entire blue area that you see marked up between candles 1 and 3, that is the imbalance in price. That is the fair value gap, right? This dotted line that you see in between the middle of this fair value gap is the 50% retracement of this fair value gap. This is also called the equilibrium of the fair value gap, okay? Now, this is very important, right? This is extremely important. And it's actually something I've been paying attention to a lot more lately. It's something recently that I've added to my risk management, is paying attention to this equilibrium. Because if you go back and backtest it, you can even see most of the time when these trades are playing out the right way, the way we want them to play out, they are respecting this level, right, which is our equilibrium, right? Price is respecting that equilibrium, right? Now, what we want to make sure that we do when we're entering these positions, right, is we want to make sure that our entry is as close to the equilibrium as we possibly can be, right? And then we start to get a rejection. We want to try to be entering when price is rejecting. Because let me tell you something, right? If you're entering here off the rejection of this equilibrium, all right, and let's just say the next candle decides to say and pushes right through as soon as you enter, right? Look how small, and I'm going to draw a box here, and I'm going to make this a different color. Let's just say, like I said, your entry was, let's just say your entry off of this fair value gap was here, right? Now, this candle broke through, and you stopped out right here, right? When you saw this candle breaking through the equilibrium, you went ahead and cut the contracts. That's a very small loss versus what I know a lot of people like to do, or I won't say like to do, but they do, is they try to wait for this candle. You try to wait for this candle to get to here, reject away, and they get all the way up here before you say, all right, I'm in. right? You're in right there as price is now rejected from that level. But now, because of where your entry is, right? Remember, our entry on the first time was right in here, right? Now our entry is right up here. Okay, our stop is now here. That's a big difference in how much money you're losing, right? It is extremely important to make sure that when you're trading, you are managing your losses correctly. You're managing drawdown correctly. You're entering at the right places, right? I mean, the strategy is easy to learn. The hard part with the whole entire thing is the psychology and the risk management. Those are the things you've really, really got to pay attention to, right? The psychology and the risk management, not being afraid to enter the trade, okay? And not being afraid to close it out when it's not going your way, right? So in this situation here, you can't be afraid to enter when you see price rejecting off of the level that we have said plenty of times. That's part of the strategy. It should reject off of that area. That's what we want to see, right? So you have to think, right? If this is not going to go my way, I would much rather be this close to the area that we're going to say, okay, we shouldn't break past this area versus being this far away because you want to be like extra confirmed that it's going to go. Well, I'm telling you what, if it doesn't go, you're going to take a nice little loss here, especially if you, right, let's just say, right, so this candle's breaking out and it closes there, right, and you're like, okay, hoping that this next candle kind of goes, does that, and it starts pushing back down into here, right, breaking past your midpoint. If you don't close right there, if you don't close right there, right, your losses just got even bigger because now it's breaking through the bottom of your fair value gap, right? Versus if your entry's here and this next candle pushes back, look at that. I mean, that's a huge difference. It's a huge difference, right? When price breaks past that midline, right? And let's just say you even let it go and close, right? And it breaks further past. That's a huge difference in how much you're losing versus when you're being overly patient. I mean, look at that. Might not look like a lot, but with stock options, I'm telling you, it's a lot. It's a lot, right? It can definitely very well be a lot. So, you know, it's extremely important to make sure that your entry is on time. You're not having, you're not afraid to get into the setup. When you see the setup and it's in your areas, you got to be willing to take them. You got to be willing to take them. So that's something I've been big on making sure I focus on, because I swear the market, like maybe about a month ago, was just belt to ass over and over again. And I'd taken a couple losses that were just like, yo, why was that loss? Like that's a big loss. And I take them a couple times. It's like, okay, whoa. So what I kind of like been looking into was just like, okay, there's got to be a better way for me to scale out or, just manage the trade a little better when it's not going in my direction. So that's when I started looking into just understanding a little more about the fair value gap. And I found out about the equilibrium in the fair value gap, right? Then that 50% retracement of the fair value gap. And then when I back tested it and started looking at it, I started realizing like, oh shoot, like every time it's bouncing off the middle and then it's going, right? I'm actually most of the time getting my entry there. I'm just not noticing it. So now that I'm paying attention to that, right? It's more so now of like, okay, now I know that if we break past the equilibrium, like I can go ahead and stop out there, right? I can stop out there, take a very small loss. If it rejects away and wants to keep going my way, I can get back in, right? As long as my entry is good, my entry's in the right spot, I'm okay. But if your entry's in the wrong spot, like I said, you're entering late because you're trying to wait for it to take off and then it pulls back and then you try to stop out at the equilibrium, that loss is a little bigger now, right? And then it rejects away from the equilibrium, you get back in again. And then maybe it pulls back again and stops you out again, right? Now, those two losses that you just accumulated because the market is chopping around were kind of decent sized losses versus if you're getting in the right spot, right? And then it breaks back past that equilibrium, stop out, right? If it doesn't break past that equilibrium, right? Like we have here in this situation, right? Like let's just say this candle here is pushing down. Yeah, that's fine. You go ahead. You ate all your food today, so you're good. It's about that ice cream time. But you see, like this candle's pushing back in here, right? And we get to this equilibrium, and we reject away. And you start entering right. Let's just say you start entering right there, right? Even if this candle continues to push back up like this, and then that next candle starts to form and starts to push out like that, you're going to be green. You're going to be in some profits. So you're going to be in a good spot to say, okay, if this does pull back, I can go ahead and close out, maybe break even, maybe a very, very, very tiny loss. You know what I'm saying? Or I can hold on to this and let this play out. And if it breaks through, I just take that little loss. You know what I'm saying? Everything really comes back down to making sure you have a good entry, right? That's just going to be the big thing here. It's just making sure you have a good entry, right? So let me show you guys my Apple trade that I took, right? And excuse the chart, just a bunch of fair value gap boxes. That's all we see here. And key levels, right? So the trade that I took was, let's see, right here, a few minutes after FOMC, and it was right in this area, right? FOMC was at 2 o'clock Eastern time today, right? And I always know with the news, more than likely you'll have like one of those little candles, a crazy candle that like wicks up to a fair value gap or EMA and something that quickly bounces off of it. When I see that, I know that, you know, the market's probably getting ready to push in the direction that it's projecting away from, right? So if it's rejecting away from EMA above, it's going to continue down, right? Or fair value gap above, it's going to reject from that fair value gap above and then continue down to whatever level it might be trying to push to, right? And we usually, and as I always say this, whenever we have news, it's a great time to be trading because there's going to be volume in the market. So there wasn't a lot of volume here, but I was able to catch this quick volume that came in and get out, right? Get in, get out. All right, so here we are right here, like at like 156, right? What I saw was two things, right? I see a fair value gap here. This is what I've got marked up. I'll slide this over, right? Right, so 1, 2, 3. Let me highlight these for you. Okay, candle 1 right here. Candle 2 right there. Candle 3 right there. Right? So our fair value gap is in between candle 1 and candle 3. Right? These are the 3 candles in a bullish direction. 1, 2, 3, leaving the gap between here and there. Right? Draw this across. Boom. There's our gap. Right? So just like we just talked about, right? Just like we just talked about, right? So we have the fair value gap created to the upside. The midline is that area that I'm looking for price to retest and bounce off of, right? So, and granted, there's some other things that go into this, like based on where we're at in price action and all the other stuff. I'm not going over that in this video. The main thing that I wanted to hit on was understanding the midline of the fair value gap, right? So right here in this situation, we had an upper move and this fair value gap got inverted, as you see, right? Inversion fair value gap is just a fair value gap that gets broken through. Right. So once we see that, once the fair value gets broken through, right, and not respected, there's two different things that can happen with a fair value gap. Right. So when you have that gap area, right, and you have that imbalance in price, that area can either be respected. What I mean by respect, I mean it pushes down to that area and bounces off of it. It continues in the direction that it's currently going. Or it can invert that area, which means it breaks through that imbalance and changes the direction, which means invert. You know what I'm saying? So what I saw here was I saw this 3-minute gap. Right, I knew we were close to FOMC, which starts at 2 o'clock. So I'm waiting to see, are we going to get a bounce off of this area or are we going to invert this area? And I also saw a 2-minute gap down here as well, right? So when I saw those two gaps, I was like, okay, we're either going to bounce off of this area or it's going to invert this area, one of the two, right? So I'm going to be looking for my entry once that happens, right? So right around 2 o'clock, oh, see, that went really quick, and that's not the speed it should be on. All right, so I'm seeing this fair value gap getting filled, pushed into, right, and boom, here I'm starting to see this gap get inverted. Now I'm chopping around from like the minute time frame to the 2-minute time frame because I know we're getting close to FOMC. I know it starts at 2 o'clock, right? So this might jump really quickly, so this might be hard for me to show you, but there's a, let's see. All right, boom, right there on this candle right here at 2 o'clock, right when I saw this candle like almost close, that's where I entered, right? Because as you see right here where this white line is, the dotted part is the midline of our 3-minute fair value gap, right? Which is the equilibrium, right? Price broke underneath it and retested this area. And we can tell it broke underneath because I was on the 1-minute time frame and it was just so close. I mean, it probably broke underneath. My box is maybe a little too low or something like that. But I could easily tell based on the fact that the price broke underneath this equilibrium and rejected away from the EMA that this was a good opportunity. I knew that if I got in here at the right spot, that if it did not go my way, I would not be losing much at all, right? I knew I wasn't going to lose much at all because here's the equilibrium. If it would have flipped that equilibrium again, then I would have got out. I would have just simply got out. Close out with probably a $20, $30 loss, right? Versus letting this play out, and well, not letting it play out, but getting in here, playing the downside, because like I said, I saw the inversion happening. I saw the 2-minute inversion happening, the 3-minute inversion happening, and just this rejection from this area in EMA just gave me enough confidence to take this. There's also another inversion up here as well. Let me drag this across. I just now saw this, right? So there's another, and look at that, right? Bouncing perfectly off of this equilibrium of this inverted fair value gap. One, I'll use arrows. Candle 1, candle 2, candle 3. I'm going to remove this so you can see a little clearer. Right? Look how clean that retest to that equilibrium is in a rejection and the EMA. You have to take that. You've got to take it, right? Fair value gap here. Price got inverted, right? We've already been in a downtrend for the day. So, yeah, I had to take that there. Knowing that if it does decide to say, you know what, it's going to flip, then I would have closed out where I showed you guys my 3-minute fair value gap was, because that was a big deal too, was the fact that I saw this fair value gap, the inverted fair value gap, right? So when I had this 3-minute inverted fair value gap marked up as well, I knew that, okay, if I'm enter here and it breaks back above the 3-minute as well, then I'll go ahead and close it out. I'll close it out and maybe change directions, right? But didn't need to do that. This was a quick 6-minute trade. Boom, caught that candle, closed out right down there at the bottom somewhere, and that was it. Right, because I'm bouncing around on a 1-minute time frame. We're well past my normal trading time. It's FOMC, so it's an FOMC minute meeting. So yeah, and then I didn't expect a whole lot from this. I really didn't expect much at all, but it made a quick move. If you're one of those people that are sitting here holding this, you're probably a little irritated right now because you were probably up a good bit and then held it thinking that it was going to keep going, and it's pulling back now. Now it's chopping around. Right, FOMC minute meetings is not like big news or anything, but there could be a few things said in there that could shift the market, that type of thing. So like I said, I know it comes out at 2:00, so I wait until the news. I wait to see the volume kick in. When I see the volume kick in, aligned with my setup, I take the trade. So as simple as that. So that was my Apple trade. I took an NVIDIA trade earlier today. I think I did. Yeah, I did. And I didn't make much at all in that trade because, like I said, this another day. This week has been just a slow week, and there's no news. Hasn't been a lot of news until tomorrow and Friday. And today, I took an Apple trade actually earlier today. That's what it was, and only made like $20 on it because I just felt like it was a great setup. Everything looked great, and see if I can go back to it. Right, and it was up here. Let's see here. I'll show you guys real quick. Yeah, I may have missed my opportunity to enter here. I reckon 948 was hesitant to get in, and it was already pulling away, so I didn't take the trade. You can't get in here; it's too late, right? If I get in here and this candle flips and pushes back that way, that sucks. That loss hurts. Because you're either gonna have to go ahead and cut it early, and then it's gonna keep going your way, or either you're gonna have to hold it and it's gonna go to your TP or your stop loss and stop you out for a big loss. So you choose, right? So I decided to go ahead and say, nah, well, let's not even take a chance of taking a big loss here. Let's let it go. It's all good. If my entry was on time and in the right spot, right, we would have been good. We would have been good if my entry was in the right area, right? So, yeah, this was my Apple trade that I took, the first trade I took today. Like I said, this happened, didn't get in there, but I saw this next fair value gap set up, and I don't know where I got in at exactly. I believe I'm in just as it's breaking away here, and I can look and see exactly what time I took the trade, see exactly what time I got in. So my first Apple trade today was at 10:06. So we were way over here. Okay, so yeah, I was getting in as price was like breaking away from this area right here. So I'll play this out and I'll show you guys exactly where I entered at. Now, what I'm looking at here, I know for a fact what I was probably looking at. Obviously, we're already in the fair value gap. And again, you see that equilibrium right there. Right now, at this point, I'm looking for price to get up under this 9 EMA. Right, this 9 EMA right here, stopping price from breaking through. So I'm going to wait until that EMA is broken or it gets underneath that EMA. Right, at that point, that's where I got in. Right when it broke underneath here, rejected away from the equilibrium again, and broke underneath the 9 EMA. That's where I got in. Right. I'm in there. Oh, shoot. Right. I'm in there. So let's see what happens here. And it started chopping. Right. So when I start seeing like this and I don't see any volume, like I don't see it creating candles like this or this or this. Like, bro, no. What are you getting ready to do? Because this is giving me all the vibes of you're getting ready to flip on me and pull back up to some other liquidity. Right, so maybe sweep out this high or something. So, with the fact that there was no news, I knew FOMC was later on in the day, so it was like, okay, the market could chop around. I'm not gonna take the chance. I'm not gonna take the chance. This is just one of those weeks, and you have to be able to. And I have another video that I posted earlier this week. You have to be able to understand and know when and when not to be trading. Right, when and when not to be trading. This is just one of those weeks where you just have to be careful. I took a nice loss yesterday simply because I just wasn't, I was itching to trade. It was another day where I should have said, you know what, let me just chill. Let me just not trade until FOMC at 2 o'clock on Wednesday. If I would have did that, my week would have been a lot better, right? Which is still not a bad week, right? Because I recovered the loss that I took yesterday today, right? But, I mean, if I just simply say, you know what, let me just stay away from today because there's no news on Monday, there's no news on Tuesday. We literally just had all these different earnings over the past few weeks. We had FOMC about a week ago. I think that was last week or the week before last. We had it was week for last. FOMC. Trump has been saying things, talking about things, right? So there's been a lot going on over the past 2 weeks that now I think the market is kind of like settling, kind of waiting for the next big move. We're waiting for like interest rate data or, anything that's going to drive the market to another level, right? So, I think that's why these past 2 weeks have just been kind of shitty, low key. Like I made decent money last week, but they were all choppy trades. It was just choppy. Everything was really quick, short. There's nothing I could really hold on to too long. So, and that was the same thing here on this Apple trade, right? And I knew that based on my previous trades and previous trades from last week and how yesterday kind of went, that I was like, I'm not going to be able to hold on to anything because there's just not a lot going on right now. There's just not. So when I saw that kind of chopping around like that, man, I went ahead and let that go. And as you see, it started pulling back, and that's what I don't want to be in, right? I don't want to be in that. So yeah, that was it for my 2 trades for today, right? I took that Apple trade at FOMC, and I also took that Apple trade during the early morning session. So as always, man, you got to make sure that you're executing properly. That is a big part here. That's why I want to show you guys the equilibrium of the fair value gap, because I'm telling you, I think it's a big part in making sure that your risk management is correct, right? Because if you're getting in, let's just say you're getting in on the bounce to the top of this fair value gap, like that's fine. There's no problem. As long as you know here at the equilibrium, when it breaks through this area, there's a good possibility this trade is not going to go your way. Because if it breaks through this area, the next level that's got to just go break through is the bottom of the fair value gap, and you're stopped out, right? So if you're going to try to hold this and see if it stops you out and rejects away and comes back up this way, that's fine. No problem. Because sometimes it will do that. Sometimes it won't. Sometimes it won't. More times than not, I think it doesn't. From what I've seen backtesting wise and just looking back through previous days, and you can do this on your own as well, look back through and see how many times you see price rejecting off of the fair value gap equilibrium like this, and then it makes this move. Right? Maybe not this many times. Maybe it's only like 2 or 3 times. But y'all understand what I'm saying. Right, this area, this middle part of the fair value gap, you've got to be ready to when price gets to that level to either go ahead and say, I'm going to scale out or I'm going to completely close out, right? And that's kind of based on your own risk management, what you have capitalized into your account, things like that, right? Like if you only got 1 trade, you might be willing to say, you know what, let me just hold this, right? If you're saying I'm taking 3 or 4 trades, you might say, you know what, this is my first trade, so as soon as it breaks that equilibrium, I'm going to take that little small loss and see what happens, right? And then maybe on your last trade, you decide to say, you know what, I'm going to hold it here because it's my last trade. I can't really trade anymore after this, especially when it comes to stock options, right? You have a certain amount of buy power, and once you use that buy power, there's no like getting that buy power back until the money settles, which won't happen until the next day. So yeah, that was it. Quick talk on Apple, quick talk on the fair value gap equilibrium. I hope that helped. I know it's helped me a lot recently with just managing my risk a little better, getting a little tighter on making sure those losses are small, because I'm telling you what, if you get in the wrong spot here on this fair value gap and it breaks back through that fair value gap, you're going to deal with a pretty nice loss, right? So this is just something to look at, something to pay attention to when you are, dealing with your risk management. So, all right, so that's going to be it for the video. Quick recap on my Apple trade that I took today, or the 2 Apple trades I took today. And really going over that equilibrium. I really want y'all to understand that and take that in, especially if you're using the fair value gap as part of your strategy, and understanding that the fair value gap has a 50% retracement, which is that equilibrium, and we want to see price breaking off that area, right? If it breaks through that area, that's a pretty good sign that that price may not go our direction, right? And by doing that, it has helped my risk management so much. It's made some of the losses that I've had a lot smaller, right? Like I said, there was about a month ago, there was a little period where the market was just choppy. And it was belt to ass like the entire time, and I'm stopping out where I would normally stop out at, but the losses are a little more than I would like them to be, because the trades aren't playing out the way I want them to play out. So that's where I got into my risk management and started diving more into it, and started realizing like, okay, maybe there's something else here that you pay attention to, and that's where I ran across the equilibrium. So here we are today, continuously growing, and that's just a part of the game, man. It's part of the game. So if you want to get started, learn how to do this, learn how to get started trading, my Calendly link is below. Book your free one-on-one call. It's completely free to hop on the phone with me and ask me any question about this stuff, how to get started, where should you get started. I help you figure out, like, based on your lifestyle, how you should be trading, blah, 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 blah. Because I know a lot of people, you work and things like that, right? Like, you're working a 9 to 5, so it's kind of hard to figure out, okay, trading may not be for me, but you're wrong. It's still for you. There's definitely still ways out here for you to capitalize on the moves that are happening in the market, even if you work a 9 to 5. So book your one-on-one call. My Calendly link is below. Book that. And as you see, Apple's making a move right now. So I'm going to have to close my laptop before I'm too tempted to take a trade. So, but yeah, other than that, y'all know the vibes, man. Like, subscribe on the video. Peace and love. We out.